most people believe governments create money. But in modern economies, banks create most of it. Most money today exists only as digital bank deposits.
These deposits form the majority of the money supply.
To understand money, we must understand how banks operate.
Money in modern economies exists in two main forms.
The first form is physical cash issued by the central bank.
Central banks also create reserves used by commercial banks.
But most money does not exist as cash.
Most money exists as digital deposits inside banks.
Banks create money the moment they issue a loan.
When a loan is approved, a new deposit appears instantly.
The bank records the loan as an asset on its balance sheet.
%. At the same time, the borrower receives newly created money.
This process is known as credit creation. Every new loan increases the total money supply.
Banks operate under a system called fractional reserves.
Banks keep only a fraction of deposits as reserves.
The remaining funds can be lent to new borrowers.
This lending cycle allows banks to create more money.
Once created, this money begins circulating through the economy.
Payments move between banks every second.
Banks settle these payments using central bank reserves. Reserves move between banks through the Federal Reserve System.
This system keeps the financial network operating smoothly.
As banks lend more, the money supply expands. Modern economies grow through credit expansion.
Mortgage lending creates large amounts of new money.
Businesses rely on bank loans to finance growth. Consumer credit also contributes to money creation.
But rapid credit expansion can also create financial risks.
Too much lending can inflate asset bubbles.
This happened during the housing boom in the United States.
Banks issued massive volumes of mortgage loans. Eventually, the financial system began to collapse.
The Federal Reserve stepped in to stabilize the financial system.
Central banks provided emergency liquidity to major banks.
The Federal Reserve began purchasing financial assets.
These policies dramatically expanded the money supply.
Central banks now play a crucial role in financial stability.
After the crisis, regulators strengthened banking oversight.
Banks must now maintain stronger capital buffers.
Risk management became central to modern banking. Modern economies rely on complex payment systems.
Today, money moves instantly through digital networks.
Technology is rapidly transforming the banking system. Today, most banking happens through digital platforms.
Digital money now dominates everyday financial transactions.
Payment networks connect banks across the world.
The banking system remains the backbone of the economy.
Modern economies depend heavily on credit creation.
Businesses rely on bank financing to expand operations.
Stable banks are essential for a stable economy.
But banking systems can also become fragile.
History shows the dangers of excessive credit growth.
Regulation attempts to prevent systemic financial collapse.
Central banks influence how much credit banks can create.
Interest rates strongly affect borrowing and lending decisions.
Credit expansion often drives economic growth.
Businesses depend on bank loans to invest and expand.
Large infrastructure projects are often funded by bank credit.
The American banking system influences global finance.
Much of the world's financial activity still uses dollars.
Banks connect financial systems across the entire world.
Every day, trillions move through international payment networks.
These capital flows shape the modern global economy.
Much of this financial system still leads back to Wall Street.
Wall Street remains a symbol of global financial power.
Understanding banks helps us understand modern money.
Money is not simply printed by governments.
Most money is created through bank lending. Banks determine how money enters the economy. And that is how modern money is truly created.